So now I'd like to invite my friend Mona Sutphen, former White House Deputy Chief of Staff, and the next panelist to come up on stage. Mona very generously gives her time as a member of the advisory board of the Center on Global Energy Policy. She now serves as a partner at Macro Advisory Partners. As you heard earlier today, we've seen the U.S. energy outlook completely flipped on its head in recent years, with oil production nearly doubling from 2008 to 2014, and then falling over 1 million barrels a day, now rapidly rising again. In the next few years, the U.S. is likely to become a net exporter of energy for the first time in nearly 70 years. And Mona is going to guide us through a conversation in our next topic about what's happening in the U.S. energy sector and what the outlook is for the U.S. Energy production and demand. I'll invite Mona and the panelists to come up. Thank you very much.
So first, thanks everybody for joining. I think this is going to be a really exciting panel, but before I get started, I just wanted to congratulate the center on its 5th anniversary. I can't believe it's been 5 years, but for those of you who've been around from the beginning, we know this was the brainchild of Jason's, but it has been a stunning success, and we know how hard it is to build something from scratch. But I think its success speaks to a desire in this sector for thought leadership spanning the capital markets, industry players, policymakers, and so it was really filling a need out there. So just wanted to congratulate everybody who's been part of that, and hopefully I'll be here for many more years watching its progress.
Can we give him a round of applause?
Yes, let's give him a round of applause. He's not even here to hear that, so I don't even know. He'll watch it on the video later. I'm really excited to be back again this year moderating a panel. We're talking about the U.S. energy industry. It is literally the topic that the entire world cannot seem to get enough of. I'd say lots of questions. The questions keep changing, the answers keep evolving, so it's really exciting. And I think this panel, we were just saying in the back, I feel like it's the superstar dream team of this sector in the U.S. We literally have, I think, some of the most thoughtful people thinking about the evolution of the U.S. Literally people who were there at the creation of the thing that we now call the shale revolution. And who would have thought that we would be in this place? So before diving in, I was instructed that we have to remind everybody who's here in the room or watching on the live stream that you can ask questions throughout, by the way, because we're just going to ask questions throughout the whole thing. So anytime you have a question, just let us know. You can do it by tweeting, which is @ColumbiaUEnergy, and then you have to hashtag CGEP events. That seems kind of complicated to me, so I'm just going to give you also the text number, which is you can text a question to 646-419-3399. So with that, I'm going to introduce the panelists. We have Amy Jaffe, who's the David Rubenstein Senior Fellow and Director of the Energy Security and Climate Change Program at the Council on Foreign Relations. She also is chairing the Women in Energy Steering Committee here at the Center. We have Peter Kagan right here from Warburg Pincus. He's a managing director there. Scott Sheffield, who's a colleague of mine, who's the board chair of Pioneer Natural Resources. We spend a lot of time together there. Charif, Souki, who's the board chair of Tellurian. And of course, Dan Yergin, who's the vice chairman of IHS-Markit. We're going to kick it off immediately. So, Dan, I'm going to start with you with a big picture question. Since you're such a student of history and evolution of this market. So, which is about the next set of challenges facing this industry. I think you would probably agree that the U.S. shale story has kind of outperformed expectations pretty much from day one across the board. And at every turn when people said it will never get to X, it got to X. It'll never get to Y, it got to Y. So I just am curious right now, it does feel to me like the industry is about to make another major turn as it matures. And I'm just curious, as you think about it, do you still feel like the sky's the limit, meaning the innovation, energy, no pun intended, excitement, nimbleness of this industry will overcome all the new hurdles that seem to be emerging on the horizon? Or are you starting to see some things that you think might be structural challenges that might not be able to be overcome?
Well, that's a very good question. I kind of feel it's a question for Scott rather than
Oh, don't
me.
worry, I'm going to get to him.
Okay. So I'll toss half of the question to Scott. I think the assumption we work on is that for the next several years, we're going to have very substantial growth. We are seeing two kinds of constraints. We talked a little bit about it in the middle of the day. One is the infrastructure constraints, the scale, and secondly, the demands of shareholders for returns as well as growth. So I think those are two things. I think we'll find out from this panel how strong the appetite of private equity continues to be. And I think Scott has a very clear view of where the growth will be, but I think that would be a working assumption. I think one other thing to me that's really striking is that until, maybe even a year ago, the rest of the oil world saw this as a really disruptive thing. I think it doesn't see it anymore as a disruptive thing. It now sees it as part of the global market and accepts it as that. So that to me is a kind of perceptual change.
Yeah. And it's really interesting. I'm curious, Scott and Charif, since you see this day to day, one of the things I've noticed is that turn. It feels like this isn't kind of something surprising or something that people can't quite get their arms around. It's now a question of how much production there's going to be, not whether it's going to drop off, whether the industry's still going to be here. And so I'm curious, just to pick up on what Dan was saying, and maybe starting with Scott, how do you feel like all of the new hurdles are going to be overcome, we're kind of regardless, and the industry is going to overcome everything kind of presented its way?
I think we had practice in the Permian Basin back in 2014. Most people look at the rig count. We're actually 15-20% above the horizontal rig count in the Permian Basin today versus 2014. We just shifted a lot of vertical rigs to horizontal rigs. And I think the Wall Street Journal article today summed it up, but pipelines will get built. MLPs, they want throughput agreements from companies. I think more independents are going to have to do these throughput agreements. As you know, like Pioneer has done over the last 5 years. You have to get your oil to the Gulf Coast. We have to get our natural gas to the Gulf Coast. And Charif knows that I'm concerned about whether or not we're going to produce so much gas in this country, whether or not we have enough LNG projects. I'm worried about the next round of LNG projects that haven't been approved. And we could be producing way too much gas in the Permian, the Marcellus, and the Utica. So people issues, I think it'll get solved. We had the same housing conditions and apartment rent rates in Midland are sky high again. So I think they'll all be overcome. I don't see any big issues. We're exporting 2.3 million barrels a day now, which is a record. And the Asians, the Europeans like our sweet crude, so I don't see an issue there. So I really don't see, the geology's there, Dan knows, and you know I've been talking about it for about 5 years. Nobody believed me 5 years ago. But, the rock is there. It's very good rock. The companies are there. They have great balance sheets. So the Permian is going to be producing 75-80% of the U.S. growth over the next several years.
Yeah. And actually, Charif, to that end, picking up just on the LNG question, there is this question of this new rise, the associated gas question. Do you think there's that infrastructure can get built fast enough for what's coming online? I kind of see, at least on the oil side, you see a little bit of a dicey picture, but it looks like it can get filled and will get addressed. But what about the LNG part, and particularly with kind of new LNG projects coming on elsewhere in the world, right, that are also competing for demand?
Short answer is no.
No?
No.
That's a short answer.
It takes time to build an LNG facility. It takes time to get the gas to the facility. And this is not instant gratification. You have to plan it and permit it and build it. It takes about 6 or 7 years from start to finish. And an additional complication, 2 additional complications today is we don't have a business model that works anymore because the market has become sufficiently liquid that as all commodities, you don't really need to enter into contracts. You know that the commodity is there. If you're a buyer, you're going to say, well, I need it 3 months a year in winter. Why for peak demand do I have to build an infrastructure or to enter into a long-term contract? And then there is a geopolitical risk where, am I welcome? Can I invest? If I'm Qatari, do my neighbors like me? If I'm American, do I like the Chinese? If I am, so on and so forth. Okay? If I'm a European, do I like Nord Stream and do I like the Russians or do I not? And so when you start putting the business model problem on top of the geopolitical problem, nothing happens immediately. So as much as I would like to, because I'm starting to see the basis in Waha disintegrate, I would love to be able to take advantage of it now, but it's not going to happen until 2023 or 24. And I have to still figure out what is the business model. I mean, the problem that Scott was talking about in terms of the excess production coming from those major basins is going to require an investment of an infrastructure of between $150 and $200 billion in the United States. Right. So, Peter, I'm glad you're here. How much can I count on you for?
Well, it's a great segue to Peter and your views on this picture and whether or not private equity capital has the appetite at this stage with all the competition from Amazon. We saw Amazon stock at another high today, all from tech and other kind of less capital intensive industries. Will there be capital there for this kind of long-term infrastructure?
Okay, so lots of things to unpack there. I'll start with just a step back and a little bit of historical perspective just on how far we've come and are we at a turning point. Because only 10 years ago, Appalachia was producing something like, 5 BCF a day. And if you look at what's happened in the last 10 years with the advent of the Marcellus, you've seen Appalachian production grow to something like 24 BCF a day. Think about that, right? It's now like almost a third of North American production. We basically replumbed the entire pipeline infrastructure of the United States in a decade, and we're able to kind of really transform the market with the development of unconventional shale. So the progress that's kind of been made is actually remarkable. As I think about where we are in the life cycle and kind of to your first question, where we're going next, I think there are a couple challenges, and that will get into your specific question that the industry's got to think about. One of them is obviously capital, right? Resources there, but investors increasingly are focused on kind of a return on capital employed or full cycle economics. They're kind of tired of these pretty half cycle 60% IRRs that some of the companies come and show, but you look at their actual return on invested capital and it's negative 3%. And there's a lot that makes companies efficient on a full cycle basis. So you're beginning to see some discipline creep into the market. And with capital, you can continue to grow, shale for a long time, but that's one of the constraints. Another one's going to be regulation and policy, right? Like, does the world want more kind of unconventional shale out there? And you need to build infrastructure, you need, kind of environmental issues. Like, as the industry begins to think about how to tackle those, that's going to be another fundamental overlay. So against that backdrop, sort of how does private equity fit in and where's private equity's appetite? We think right now is a really interesting time in the energy sector. And your segue with Amazon and questions about that, I work at a global private equity firm that invests across industries. And when I tell my partners about the valuations of the opportunities that we can see in energy right now, they just sort of salivate. I mean, you can find really interesting producing assets if you have good, good teams that are, trading at 12, 13% yields or return on, free cash flow yields, or put another way, kind of 3 to 5 times EBITDA multiples, right, for certain types of assets. Whereas in the rest of the market, we're kind of in nosebleed territory right now. So because a lot of capital's kind of left the sector, because there's more discipline, if you think about public equity markets in 14, 15, and 16, they averaged $22.5 billion a year of public equity raised for new energy issuances. Last year, that number was $7 billion. Right, so there's a lot less capital going into the space. So that creates an interesting opportunity for private equity. We're not the only ones who think that, but we're very excited about sort of the continued opportunities we see in this landscape.
So picking up on the question of kind of the outlook and demand, will there really be there? Amy, I'm really curious because I know you've spent a lot of time thinking about the transportation sector demand here in the U.S. And I do want to start talking about policy and just policy uncertainty more than the policy or the swings in policy. But from your perspective, is the most important thing for people to think about and watch for the long-term evolution, transportation infrastructure in the United States and the EV penetration and that kind of thing? Or are there other issues that you think people really need to think about?
I think because we've been talking about the investment climate, one of the things that's happened in the oil industry that's very new is that, in the past, ample capital or not ample capital, it goes up and down with the swings in the oil price. But there was always this belief that there was no uncertainty about demand. We had these stories about China and India and the middle classes of the developing world. And those stories are still kind of around, but they've been sort of dented by some of these things you've seen, which you would think would have been impossible even a few years ago, which is announcements by major countries, including China, that they are going to ban internal combustion engines. So not just we're going to give a subsidy for EVs, but we're literally going to make it illegal to sell new cars in our country that run on gasoline. And, we've done some modeling of that. So, it's not just, 2040 seems like a really long time away, but I'm a car company. I have to start making my plans earlier than that. And I'm an infrastructure planner. I have to start making my plans earlier than that. So we see the impact of that, if those bans look like they're really going to stick, and the Chinese are talking about that, so having the infrastructure impact come forward maybe a decade, right? So even if it doesn't happen, the fact that it's been announced, the fact that you can see countries, taking those policy steps creates this tension between the fact that we can get a 13% rate of return, next year if we invest in, Project A, and this concern about how many years can I get that. So you're getting in the industry this sort of tendency to short cycling. I want to invest in something. I want the payoff to be in 5 years or 10 years max. And so that's changing the kinds of projects that can get funded. It's changing the nature of what reserves seem most attractive. And I think it's going to bring a big change. And to the extent that over time, now with an OPEC, the big debate is really how high a price would be a problem. Because in the thing I'm talking about, you just heard on the panel before us, the gentleman from India was speaking specifically about how higher oil prices will encourage energy efficiency. And you have a lot of buildup now and pressure about air pollution. So to the extent that OPEC makes this decision, there were these headlines about considering $100 again or $80 again, price starts moving up to that level again, the impetus, whether it happens here in the United States or not, it's not almost important. It's going to give the impetus to other countries to move faster in these areas. It's going to make consumers less interested in this SUV trend that we've been seeing over the last 2 or 3 years. And you may be swinging back to looking at these dual fuel cars or more efficient cars.
I was just going to say, and Dan, maybe I can get you to comment on this a little bit, which is there is this long-term picture that you're painting, and yet demand seems, at least for now, seems to be, as economic growth is decent, and there's a whole question of what's going to happen, obviously, with GDP growth generally. But it does strike me that it is good to be skeptical about whether or not that vision ultimately emerges, in part because also the higher oil price will stimulate, obviously, more production, too. If you end up, I don't know how long we think we would lead with $100 oil before you'd end up with a policy response and a market response. So I'm just curious, Dan, how you feel about that. Are you feeling like people are baking into the cake too much of what Amy's thinking and like, okay, it may not get that far, or?
Well, I think the kind of statements that Amy's referring to have to be taken either seriously or, as you suggest, semi-seriously, because you also hear it in terms of inner cities in Europe and so forth, the mismatch of policies, and then it's against that is the dynamics of markets. The other thing that's happening is that, automobile companies are rebranding themselves as mobility companies. And there's, of course, the EV side of it. There's also what's the impact on demand of ride hailing? What's going to be the impact on demand of autonomous vehicles? What will be the nature of those vehicles? So I think there is a lot more uncertainty. When we did, the scenarios on our reinventing the wheel project that we worked on for a year, I mean, you can look out to 2040 and have very different views of the future, and you can say both of them are reasonable. The only thing is, and I know Fatih will talk about this, is the pace of which the automobile fleet changes and how much bigger the automobile fleet will be. Probably in 2040, it'll be 2 billion vehicles as opposed to 1.3 billion vehicles. And so there'll be a lot of gasoline vehicles, I think, still then.
Yeah. I mean, there is such a divergent path. That's part of the reason why it's such a challenge, I think, for everybody to figure out. It could be any range of quite extreme scenarios all the way across to basically the status quo. And actually,
Can I just say something?
Yeah. Huh?
So at our CERWE conference, you know, when Mary Barra, the CEO of General Motors, said, our goal is to produce cars that have zero emissions, zero accidents, and zero congestion. But in particular, zero emissions, that got the attention of a lot of people, even though most of their vehicles are gasoline powered and will be gasoline powered for some time.
Yeah. And actually, Scott, it's picking up on something that Amy said. I've heard you say in the past that you're worried about a sustained high oil price and implications just generally. Is it for the same kinds of reasons that you just think it's going to stimulate?
I've seen it happen before, but every time I pick up the paper, MBS, Mohammed bin Salman is saying he wants $70 oil, then $80 oil, then $100 oil is the recent one. And, you know, we're going to lose demand. It's going to move more toward alternative energy. More people will buy electric vehicles. So the only thing working in our favor today is the strip is in backwardation. Mm-hmm. And so 5 years from now, it's $51 for WTI. And so, you know, producers aren't hedging, which is probably good, because if we were all hedging in the out years, if it was a flat $70 price market, we'd all be hedging today pretty aggressively out 2 or 3 years, but we can't hedge. So that's the only good thing about that it's in backwardation. And so if you look at the break-even price of these basins now, the Permian, the Bakken, the Eagle Ford, it's down into the between $20 and $30 a barrel. And if you look at there's been some recent reports, break-even price of the OPEC countries, even Saudi Arabia is trying to move it down to $40 to $45 oil from $70. And so it just points toward long-term, we're probably in a $50, $55, $60 market, in my opinion. So I don't think it does anybody any good to see $70, $80 crude.
Yeah. And actually, to pick up on, I wanted to talk about capital efficiency a little bit, because the capital discipline a little bit, because do you think if prices, let's assume for a while that prices do evolve the way the Saudis anticipate or whatever, that are above $70 a barrel for a long time, do you think this current focus on capital discipline is likely to stay? Is that a permanent feature, or is that likely to kind of disintegrate as sorry, Peter.
No problem. Well, you know, one thing, I've been kind of investing in the energy world for over 20 years, and one thing you do learn is that markets have short memories. So, you know, today there is a real focus on return on capital and capital discipline, but you begin to get to those higher prices, these producers are going to generate real returns. These shale companies actually do perform, and you're beginning to see companies like Pioneer and Conoco and a bunch of companies continue to improve their returns on capital employed. So with higher prices, they're going to continue to improve more, and that's going to attract more capital, and that's the way markets work. So I do think investor focus tends to move a little bit. I just wanted to pick up a little bit on the comment on long-term demand and EV, because it's an area where we do a lot of work. As a firm, we actually have investments in electric vehicle manufacturers in China, and we're both constructive on EV and on long-term demand, which some people think is a bit of an oxymoron, but we actually find that it works. And you have to realize this is a really big industry. There's a lot of install base. For most people, their car is a big investment and has a 10-year life. So it's an industry where kind of change happens a little more slowly than sometimes people who are used to kind of, technology adoptions might actually think. And so the work we've done is we've kind of, today EV sales on a global basis are something like 1.5% of new car sales, maybe even a little lower than that globally. As we look forward, and if we modeled out to like 2030, even if we assume that a quarter of all new car sales in 2030, so a pretty rapid continued growth in EV, like a really vibrant EV market, are all electric by 2030. Even going out to 2035, 2040, you're still seeing liquids growth. And actually, their new numbers came out today just on U.S. liquids demand, and you saw that United States, oil demand grew 1 million barrels a day this year. Very little of it. Miles driven is down, a lot of it's petchem and kind of other sources of supply. So, our sort of view on this is you need to be very attentive to these long-term issues. You need to be paying a lot of attention to them because changes are happening. But you can actually believe that electric vehicles are going to continue to grow and play an important role, and actually think there's a reasonable investment window, for long-term liquids.
And in terms of, can we just stick on the demand question and the policy response? One of the things I'm really interested in, Charif, and well, actually for everybody, is the necessity of having more policy stability in order to support the continued growth of this industry. It strikes me that, I think Scott and Charif, because you both really were leaders in pushing federal policy change to allow for LNG exports and later crude oil exports, and an important change. But with this administration, you've seen some shifts, not shockingly, on things like methane and CAFE standard and drilling on federal lands and the like. Is the industry just resigned to the ebb and flow, the pendulum swinging, and potentially swinging more violently maybe than it has in the past? Or is that becoming really, in the end, going to be a serious overhang, at least for the United States relative to other places where there might be more policy stability? I'm curious, Charif, how you feel about that.
I think the political side exacerbates a problem that has always existed. I think first, volatility was always the nature of the game because things change so fast that you have to adapt. What you had some confidence in the past is that there was a reversal to the mean over a long period of time. So if you had a strong balance sheet, you could support and withstand the swings on a short-term basis or even on a medium-term basis, 4 or 5 years, and then come out on the other side and benefit from the good times. I think what is happening now is that the investment cycles are shortening. The returns are being pushed into a higher risk and then a higher return expectation, but where most of the investment community is not really comfortable. So you're going from, okay, I can assume that over a 20-year period, I will get my money back and I will get a decent return, and I may hit it wrong, but it doesn't really matter because over the long term, I'll be okay. And now, with all the things that you're seeing that are secular changes, that you may not have the tail. And therefore, you have to accelerate your process. And you want to be at a better return kind of profile, and therefore, you have to accept additional risk.
Right.
And all this exacerbates, and then the geopolitical concerns add to the uncertainty.
And Amy, I guess one question for you. Do you think it's possible for there to become, at least at the core, a consensus, and Dan, maybe for you as well, like core consensus around some of the key bedrock areas, at least of the US? Like I'm talking about methane and things like that, so that you would end up, I mean, you can't do anything about the geopolitics. I mean, maybe you can, but that's going to do what it does. But at least for the parts that you can control, that we eventually will settle out into a stable place to avoid the kind of churn that Charif was talking about.
I see sort of a different path forward, but answering your question exactly, which is that increasingly companies are making independent decisions, right? So corporate leaders are saying to themselves, I'm not going to change my strategy or what I'm doing, not so much on supply, demand, and investment, but on my CSR program, right? If I'm a company today in the United States, first of all, you have to in Colorado and Wyoming, but if I was serious about methane leakage and thinking about what to do about methane leakage, I'm going to pursue that anyway. Regardless of what the regulatory framework would allow or not allow me to do. And some of that comes through private equity even, because you've got your investors who have stakeholders that care about that, so they're going to hassle you and call you up and tell you about their CSR policy. Some of it's, you're a public company, and you don't want to be activists marching around in front of your company talking about your methane leakage. So, and also, there's if Charif gets things going, you're going to be able to do something with that gas, hopefully. So I think there is this pressure, right, to have companies show that they are performing regardless of what the actual regulation is requiring you to do. I mean, companies are going to recycle their water, regardless of what the rules are. Companies are not going to say, oh, they're relaxing the clean water, regulation, so I'm not going to worry about water. But I think even more importantly, and this is the interesting thing, because I just was looking at it recently, if you go into the DOE forecasts and you look at they have a good model, they're projecting what's going to happen in the U.S. electricity sector, and you look at the emissions consequences of their different scenarios, the high resource case scenario, which is sort of the Trump administration scenario, right, has lower carbon emissions than the Clean Power Plan scenario.
Really?
And lower still than the business as usual. So, ultimately, what I tell people is some of these things the market's going to take care of it to some extent. You're always going to have the occasion, you're going to have these bad players. I mean, we all know that, and that is really, in my opinion, what the EPA is for, right? But the industry itself has other pressures that have nothing to do with the fact that they're worried that the EPA is going to come down and police them or that, even on CAFE standards. If you're these car companies, I just went to the auto show, here in New York, and my husband and I walked around and we sat in every hybrid plug-in car they had at the auto show, and pretty much every company had one.
Right.
And they were beautiful cars, very comfortable, and there were a lot of families getting in and out of those cars. So, I think that it would be kind of interesting to see, what the market actually delivers, because there's so much uncertainty with this swinging back of regulation.
And actually, Peter, is a really, just because you are doing so much forecasting, this question of the regulatory impact, how much does that factor in the shareholder resolutions, that trend line? Is that something that I'm assuming market factors are still the dominant, if you had to allocate percentage-wise of the consideration? I assume that.
I really like what Amy said there, in that companies are doing a lot of these things on their own, some of it by their boards, and I don't think it's just private equity boards, kind of pushing more for ESG and social responsibility as something as a very important factor. In terms of the deployment of capital, I think as we've thought about running kind of our energy portfolio, we've thought about internalizing a carbon cost for a long time. And so when you look at our portfolio, we have no coal. And that's not an accident. So it's very hard to kind of, in a policy abstract, kind of do that. So I don't want to, as you think about kind of building your forecasts and models, it's obviously an imperfect science, but we try to kind of use some parameters that, imply a policy shift on carbon and bake that into kind of how we think about economics today.
Yeah. And I'm just one more question on the policy realm, and then there's a couple of questions from the audience that are a little bit more technical, and I'm going to warn Scott, gas to oil ratio is coming up. So one question, I guess, is for Dan and Amy, really, is opening up federal lands for exploration and drilling. You envision a scenario in the near to medium term where you see competition between oil and gas and renewables for access to those lands? Is that going to set off a wave of competition? Is that something that you see coming down the pike, and if so, when?
I guess I would say, and I know companies who've talked about doing this, ironically, the way the surface is utilized, I don't think it has to be a competition. You've got some oil companies today out in Texas that are literally looking at, could they do something, if their shareholders care about their carbon footprint and they're looking at, sort of doing something in CSR that would be appealing. You've got companies that are looking at, both doing wind and oil and gas in the same, physical space. Mm-hmm. So I don't know it has to be necessarily in either or. I think the bigger problem is just NIMBY, right? Is that all these communities don't want any kind of facilities. It's not about just oil and gas.
They don't like the windmill either.
They don't want a windmill. In California, utility scale solar has trouble with permitting because of animal habitats and other kinds of issues. So I think the more challenging thing is this permitting. And the interesting opportunity to me in terms of, what technologies might win is I think that that gives a little bit of an edge to distributed systems, right? Because they're smaller scale, it's a little easier to put in. You've got companies, you know, like HEB in Houston was able to put in their own distributed network, but it's their property, right? You know, you have Microsoft with its own headquarters, it's their property, right? So, you know, if we continue with this thing that nothing can be permitted, I think it will push people towards, you know, distributed systems.
Yeah, that'll be.
Well, first of all, permitting is a really big issue. It's a sort of invisible issue, but things shouldn't take 10 years or 12 years to get done. I mean, they should be decided more quickly. I think second thing to say is, I mean, it's interesting, public lands. I think that 48% of the western United States is public lands. So there's a lot of land there, actually, and different uses for that land. Third thing, and I think from what Amy said, I think we will see renewables becoming part of oil and gas production. I mean, fuel cells will be used, I think, in the oil field, and that will be hopefully one of the ways to address methane.
And actually, to that end, Scott, I'm curious, I did want to talk about the innovation story in the U.S. Production cycle. And I think one of the things that I've been struck by, just as an observer really, is not so much the technology development, because I think that's pretty well known, it's the technology adoption rate is so fast relative, at least in my mind, to other sectors. I am stunned at how fast learning takes place and is deployed and redone over and over again. I mean, faster than Silicon Valley, faster than anything I've ever seen, actually. And I'm curious, because you've been there at the creation, the present, at those major inflection points, are there things going on today, now, that are cutting edge that you think 5, 10 years from now, people will look back and say, aha, that set off a whole nother wave of innovation that we hadn't anticipated?
Yeah, sort of going back in time, on 2014, our break-even price in the Permian Basin was probably $55, $60 a barrel. Oil, we were getting 90, so who cared that it was $55 or $60 a barrel? Oil was 90. We thought it was going to be 90 for a long period of time. I would have never thought that the Permian Basin could drive down the break-even price to the low 20s. And we did it through the size of the frac job, the size of the amount of water and sand we use. And secondly, we were all trying to get out 200, 300, 400 feet frac height. And we realized there's so much oil and gas around the horizontal wellbore that goes out 10,000 feet. The goal changed to break up all the rock around that horizontal wellbore, because we're leaving so much oil behind. And so the wells have improved probably 300% from 14 to 17. And so that's why the break-even price is primarily down. Now, going forward, we get asked all the time, what could happen? The Permian Basin is different for the ones that don't know, because there's 4,000 feet of shale. We got 12 to 15 bench zones. We're only going after 3 zones now. And so the next technology, can you imagine, and we're, from a land standpoint, we have to drill every time we drill a horizontal zone, we have to drill a vertical well. And so can you imagine if we just drill one vertical well and can drill those 12 zones all at the same time, and then frack them all and produce them all at the same time? That will be a step change in regard to increases in production. And so it's been tried for 3, 4, 5 zones. The economics aren't quite there yet. We know we can drill it, we know we can horizontally, but how do you produce it without what we call thieving, because they're all at different pressures? How do you produce them all? But that's the big step change I'm waiting for over the next 10 years in the Permian Basin.
Yeah, very interesting. Actually, since I have you on this, the gas to oil ratio.
Somebody asked that question?
Yes, of course. You know somebody's going to ask that.
Well, first you got to explain. Most people probably don't
exactly.
know what
That's what I was going to ask
ratio
Scott
is.
for the tutorial on the gas to oil ratio. And I mean, we know why it's important, but gas to oil ratio, and also, is that in your mind? I mean, is that the main factor that's really driving this question about takeaway capacity in the gas space? Is that going to
yes. In a vertical well, you have to realize there's over 100,000 wells drilled in the Permian Basin over the last 50 years. And the vertical wells, the gas-oil ratio is just taking your gas divided by your oil and creating a ratio. And the ratio that we used was about 2,500 to 1. And so that's what we used on our vertical wells. So we assumed, most companies assumed that the ratio would be the same on horizontal wells. So the gas oil ratio increases with time. So it started at 1,000 and eventually gets up to 2,500. So it's like a simple way is like opening a Coke bottle and you see the CO2 escape. If you open the Coke bottle slowly, it'll escape slowly. If you open it quickly, it'll escape quickly. And so we're depleting the reservoir. And so what's happened on horizontal drilling, we're actually breaking up so much rock and releasing the gas so much faster, is that the gas oil ratio is increased significantly. And so when Pioneer announced this issue about, I guess, over a year ago, I think our stock was 180, it went down to 125. It's back to 195 today. So I think it's recovered. And so the whole Permian Basin was tainted that, okay, it's a gassy basin, it's all going to produce gas, the oil is going to be trapped. And so the oil is unaffected by this gas oil ratio. What it means is that most of our wells are going to produce 20-25% more natural gas over its life. And so when you look at Pioneer's website, you see we're going to 1 million barrels a day. In 9 years left, 700,000 barrels of oil. But what's happening now, they use the word plus. We're going to produce probably another 20-25% natural gas. Because the gas is releasing out of solution faster because we're breaking up the rock. It's like open up the Coke bottle faster and the gas comes to surface. So that presents opportunities for Charif.
Right.
So the estimates on
he doesn't seem to want. I don't know.
The estimates on the Permian Basin is producing over 10 BCF a day now. So it's the second largest producer in the country.
He's saying how much?
And most estimates have it going to about 20 BCF a day. But that doesn't take into account these new gas projections. And also Apache's discovery, which several other people are making some fairly strong wet gas wells. So I think the Permian could easily get up to 25, 30 BCF a day.
Yeah.
Marcellus is at 25, 26.
Right.
And it's going to 35 to 38. And so Permian will be right behind it.
Yeah, so to that end, Charif, I just wanted to go back to you, and maybe, Peter, you want to comment on this. Like this question of what happens to Marcellus and elsewhere, it strikes me, it sounds like it is a genuine bottleneck, at least for some period of time, until capital decides it wants to invest. Do you think that there's a role for sovereign wealth funds, other people who might have an interest in financing this kind of energy infrastructure for the long haul LNG, right? Who just want a different supplier other than the Qataris or whatever?
I think the last thing I'm worried about is availability of capital.
You aren't.
Having the ability to access the capital at a reasonable price is a different story. But when you start talking about people that are not in the United States, it's not a simple profit motive anymore. There are different considerations that go into the picture. But as I said before, you shift your risk-reward expectation. Mm-hmm. So you want to be the low-cost provider because you're now in a commodity business. However, if you're the low-cost provider, you can go through the cycles and survive the bad times, but make a lot of money in the good times. You have to accept that you're going to be on a different risk-reward profile. Right. But I don't think there's a shortage of capital. There's capital everywhere in the world, and some of it wants simply to secure cheap natural gas. So in that case, the idea of what is my profit return is not very important. The cost of capital is very low. They will benefit in other ways. They will be able to supply their economies with cheap gas for a long period of time. Right. And that is the prime consideration. Yeah. So we're searching always for the most efficient things. For us, there's 4 things. Cheap gas. Scott is making sure we have it.
I was just going to say, Scott is,
infrastructure that is built to bring it to the facilities, because if you're going to Pennsylvania and then come back down to the Gulf Coast, it doesn't help you. Right. So you want the most efficient route to get there. We're good at building liquefaction facilities, so that's for us is a given. And the last thing is we want to access the cheapest capital we can find. Mm-hmm. So if you put those 4 points together, you're the low-cost provider. Sometimes you will make a very low return on your investment, but sometimes you look extremely well.
Really, really well, yeah. And so it sounds like, though, then your constraint is really just the time lag with the permitting and just making sure everything kind of lines up. Is that a fair way to describe it?
That is the fundamental issue that we have. But we now, somebody said earlier that we have maybe a 10-year cycle, a 5-year cycle comfortably, but a 10-year cycle a little bit stretched, and not more than a 10-year cycle. In that context, if it takes you 5 years to build a facility, you've already missed half the cycle. So you have to try to predict what's going to happen 5 years down the road, having absolutely no idea where you're going to be 5 years down the road.
Yeah. And so it sounds though like obviously the long-term contracts, to the extent those anchor, just like we're seeing on the oil side, that presumably has to be a factor in securing the
I think long-term contracts are a thing of the past. In
Really,
a commodity business, you don't have to enter into a contract. And if you go to Europe today and you tell them, I want to enter into a long-term contract to supply you gas, they'd say, I'll write a contract if you want to, but it's based on my local index, TTF. So I don't need a contract. I know what TTF is every day of the year.
Yeah.
So send me gas at TTF. I don't need a contract.
We've gotten a couple questions about risks in the actual production. We get just seismic risk, water risk, those kinds of questions. Dan, and then all of you actually, do you see those kinds of risks increasing, decreasing? There is obviously a question about water treatment and all the rest. And where do you think we are in that picture? And obviously we don't have anybody who's operating in Oklahoma right now, but obviously they're seeing the highest level of seismic, which I've always thought, frankly, is the most of the risks out there, the one that is hard, obviously by definition, hard to overcome if you know what that is. And obviously you need to track it and all the rest like they are now in Oklahoma. But just curious, and Dan, I don't know if we can start with you.
I think some of the risks that are seen as the political risks are really as physical risks are really political risks.
Right.
And they may not be physical risks, but they're seen as physical risks, and therefore they become political risks. I think, as you said, seismicity, swarms of earth tremors, earthquakes related to reinjection of water where it shouldn't be, I think is understood to be the problem in Oklahoma. But I think, and I'll defer to, Scott on this, but this is a highly regulated industry, and it's not a Wild West. Part of the argument is this, and we saw it as, is this going to be regulated by the federal government? In what ways, and what's going to be regulated by the state governments? And I think often people don't realize how much is actually done by states.
Yeah, Scott, I don't know if you want to comment on the water story, because I think there is a lot of innovation there, but obviously it is costly to figure out how to create a closed water cycle, so you're limiting your use of clean
I think
water.
to close off the seismic in Oklahoma, as you know, we have a board expert on our board at Pioneer that worked right in the middle of that, who was dean of the geological engineering school at Oklahoma. But basically some small producers they drilled their disposal wells right next to a fault zone, and so they were deep wells, disposal wells, and so they were putting their water and disposing of it, and it was going into those fault zones and lubricating those fault zones, and they started slipping. And so what's happened, both in Oklahoma and Texas, they've put in they started hiring geophysicists to work inside those corporation commissions, and so they've staffed up, and when you drill a disposal well now, it has to go through that approval. In regard to, as Dan says, it's highly regulated. In regard to water, I think Pioneer is probably one of the first. We had a 10-year plan 5 years ago, and we realized that West Texas doesn't have a lot of water, if y'all been out there. It doesn't rain a lot, and so we didn't want to depend 100% on fresh water. And so we started a plan about 5 to 6 years ago on going outside to the cities of Odessa and Midland and using wastewater and treat it. So our goal is not to use any fresh water by 2020, and also non-potable water zones. But most people in the industry are trying to move away from fresh water and recycle also.
Yeah. And it's one of the things I think, I mean, is your vision in the end, I know there's so many different operators. You always have to worry about the operator that decides to drill, reinjection wells near a fault zone or whatever. Do you feel like, because what I kind of observe is that the industry is really bifurcating a little bit in that you have the bigger players like Pioneer, big balance sheet, the capacity to invest in a 10-year water plan and all the rest. I'm just curious about this story around consolidation. I think people have been waiting for consolidation in this arena in the US for some time. It's never happened, or maybe you think it is happening now with this Concho transaction. I'd be curious how you see that, and Peter as well. Are we about to see a wave of consolidation? Because people, we've been talking about all these things require tons of capital, right? And somebody needs a big balance sheet to be able to pull that off.
Tim Leach used to work for me for a long time, so I know he likes to get bigger. And so at the same time, the company he acquired has, I think he said it on a conference call, they have longer, they can do longer laterals. Their acreage is more contiguous, and that's very important to have long contiguous acreage. Your economics improve significantly. So I look at him improving his inventory, so he's going to put RSP acreage in front. In regard to Chevron doesn't need to do anything, in my opinion, because they bought Texaco a long time ago. So they have a great inventory, and Exxon is buying private companies. And so if you look at the Permian, Peter can comment on it, but if you look at the Permian companies, they're trading fairly expensive compared to other companies. And if you try to get a major to buy and pay a 30% premium on top, you know, they're paying, Concho paid $75,000 per acre. The majors, I just don't see the majors paying $80,000 per acre.
Right.
I just don't see it.
In your view, does that mean the majors aren't in this play, really? I mean, Exxon's will be there, obviously.
Oh, Exxon and Chevron are.
Well, but
Shell,
the others won't.
Shell is. The rest of the majors are cut out.
Yeah.
Total, BP, Repsol, Eni, they're out. Yeah.
Right. Yeah. Just thoughts on that.
If you come back to where you started about how, you know, Shell's kind of matured and reached its next evolution, as you think about how the industry ought to evolve, I feel like consolidation is going to happen. And Scott, it really comes back to your point around, you know, drilling the cube. To me, the capital efficiencies required to kind of, you know, drill a whole section all at the same time, which is the most efficient way to do it, requires huge amounts of capital. If you're a small company and you're investing, you know, $80 million to develop one pad, that's going to screw up it's going to make it really hard to be a public company. If you're a bigger company with scale, you can do that more easily. So I continue to think that as these plays mature, you will see more consolidation. But obviously,
are you surprised there hasn't been more to date?
We've been in it's been a pretty tumultuous energy markets the last few years, right? So I think that's kind of people
valuations are a little hard to come by.
So I think that's been, and Scott's right. You know, kind of finding the right entry points are difficult. So I think you'll see more, but you know, it may take some time.
Yeah. Okay, we have 1 minute left, so we're going to do a lightning round, and I have two questions because maybe we'll be back. They'll invite us back next year. Okay, so I have one. These are two yes or no questions. We're just going to go around. So the first one is, do you think the United States will have a carbon tax by 2025? So Peter, I'm going to start with you.
Yes.
Okay. Scott?
No.
Yes.
Yes, I'm on the record in the Wall Street Journal.
Yes.
Yes. Okay. All right, Scott.
I'm
You're the only one out, man. Okay. All right. And next year, when we have this roundtable, do we think the price, WTI price, is going to be north of $70?
Let's go first again.
No. Okay. We'll start with Charif. We'll come back around.
Yes.
Really? Okay. Yes.
Yes.
It's hard to tell.
You got to commit.
Can you just tell me what GDP will be?
Oh, yeah. Okay.
Give me
So
a
you want the
GDP.
caveat. Yeah. No, I'm not going to give you the
You
caveat.
gotta give
Next
GDP.
year. I mean, this time next year. So
This
think
time
about
next
that
year.
in the cycle where we are in the cycle.
So I think the
Spot
problem
price.
is it's definitely going to, you know, we definitely have this geopolitical risk. So the question is, how fast does it slow down the economy? I think
Right.
that's what
Exactly.
Dan's trying
That's
to
why
say.
you're. Yeah.
That's the concern.
So you say what?
So are you a yes or no?
I tend not to do price
Okay. All
work.
right. Don't do a price. Okay.
I'll
all
say
right.
no.
Okay.
Yeah.
No. Okay.
I'll go yes.
Okay. We'll do a yes. All right. We're more divided on that.
I'm an optimist.
Yeah. Right. Okay. Well, thank you, everybody, and thanks to those who submitted questions. Really appreciate it.